How did Basel Accords evolve banking regulation? Imagine a world where banks can take risks without risking the entire financial system. That's what international banking rules aim to prevent. The Basel Accords are a series of rules created to keep banks safe and stable worldwide. They started because of financial crises and the need for better oversight. In the 1970s, banks faced big problems like currency swings and failures. Leaders from 10 countries formed the Basel Committee on Banking Regulations and Supervisory Practices in 1974. Their goal was to improve how countries supervise banks and work together. The first big step was Basel I, introduced in 1988. It set a minimum capital requirement of 8% of risk-weighted assets. That meant banks had to hold enough money to cover potential losses, depending on the type of loan or asset. For example, government debt had a 0% risk weight, while commercial loans had 100%. This made banks more careful and created fair rules across countries. In the early 1990s, Basel I was updated to clarify rules on loan loss reserves and include risks from trading activities. Banks could also use internal models to estimate market risks, making the rules more risk-sensitive. Then came Basel II, published in 2000 for after nearly 6 years of work. It aimed to make capital requirements more aligned with actual risks. Basel II introduced 3 pillars: minimum capital requirements, supervision, and market discipline through transparency. It used more advanced methods to assess credit, market, and operational risks. It also encouraged regulators to work closely with each other, especially for international banks. The global financial crisis of 2007-2008 revealed weaknesses in these rules, especially around the quality of capital and liquidity. In response, Basel III was developed starting in 2010. It raised the standards by emphasizing common equity as the main form of capital and introduced a leverage ratio to limit borrowing. Basel III also added new rules for liquidity, including the liquidity coverage ratio and the net stable funding ratio, to make sure banks had enough liquid assets and stable funding sources. It expanded risk coverage further by requiring capital for counterparty risks in derivatives and large exposures. Later updates, sometimes called Basel IV, continued to refine these rules. Over time, the Basel Accords have shaped how banks are regulated around the world. They promote consistent standards, better risk management, and stronger resilience against shocks. These rules have helped regulators cooperate across borders, reflecting the global nature of banking. Banks have adjusted their strategies, risk models, and disclosures to meet these evolving standards. This ongoing process shows how financial regulation adapts to economic challenges and crises, building a safer banking system for everyone.